edition of MFB News. I hope everybody's well and kind of faring positively after the autumn statement. It's been a really mixed reaction actually when we're speaking to landlords. There's a lot of you who are sort of taking a fairly philosophical approach. It could have been a lot worse. At one point we thought we were paying 8% national insurance, a 2% income tax feels slightly less horrendous. Equally, you know, it's not just a landlord tax, it's been applied to dividends and savings interest as well. So we don't feel like we've been totally victimised. And other people are absolutely incensed, feeling that landlords are being singled out yet again. And all of those really, really sad things. So be interesting to see where you guys sit. I think what it's fair to say is that Labour have certainly not earned themselves any landlord voters on this autumn statement. Now, we're going to move away from politics for today, actually. We're going to talk about the market more broadly, because that's what we're here to do. We're not a political channel. So what are we going to be covering off for you today? We're going to be talking about swap rates, in particular how the reaction to the autumn statement has gone, what this means for your mortgage rates. We're going to be giving you a couple of pieces of lending criteria changes that have been brought in the last week. Very, very interesting ones, very positive. We're then going to be talking about pets in properties. There's been kind of further movement in terms of the rules that sit around pets in properties, more specifically how you can refuse them whilst also being reasonable. So we're going to talk a bit about that, because I know a lot of you are quite concerned about this particular aspect of the Renters' Rights Act. And then finally, we're just going to have a little bit of a look about how people talk about house prices and make some sense of how they're actually kind of formed. Because often you will see, you'll have someone like the Nationwide saying the average house price is X, Nationwide saying it's something totally different, Zoopla and Rightmove again giving very different numbers, just kind of trying to give the information to really understand what's going on there. Okay, so let's kick things off with our usual looking at the capital markets and what's going on with swap rates. And also we're just going to have a quick look at gilt rates as well, because we have had the autumn statement. I was very concerned about the impact this would have on the market, and it could have gone either way actually. But thankfully things seem to be fairly neutral, and I'll go into what I think that means in a moment. I'd love to hear your comments. But essentially after the autumn statement, gilt rates dropped a bit, then they went up a bit, and then they just sort of come back down to where they are. So basically in terms of gilts, no major changes. And it's a very, very similar story to swap rates. So as we know, in the run up to the autumn statement, things went up, then they came down, and now they've kind of settled back at where they were before we had the yo-yoing. So 2-year swaps 3.47, 1 month ago 3.49, so no real move month on month, compared to 1 year ago where they were at 4%. So year on year we're in a better place, but actually month on month there's no real change. And same story for your 5-year swaps, 3.58 as of last night, 1 month ago 3.56, and 1 year ago 3.79. So actually in terms of where we are year on year, we've made progress. Month on month, no real changes. Now in terms of what I think this is really telling us about how the markets are perceiving the budget, I think there's no escaping the fact that the way it was kind of rolled out was embarrassing, to say the least. All the many leaks in the run up to the budget, or leaks, you know, were they actually leaks, who knows? And then the OBR releasing their statement in advance of Rachel Reeves actually getting to the dispatch box. The whole thing was really kind of a bit of a farce. However, what I find very reassuring is that actually gilt rates haven't gone bananas, swap rates haven't really moved. And this tells me that while people think the government maybe lacks a bit of credibility in terms of the way the autumn statement has been delivered, what they're not seeing is financial Armageddon for the country. Now, I appreciate on an individual basis, we're all going to be impacted very differently. I'm not sitting here kind of, you know, from a position of enjoyment. You know, I'm going to be worse off for the autumn statement. All of you who have rental properties in your own names will also be worse off. So, you know, there's no escaping that fact. But I think in terms of how it's been perceived from a kind of external lens looking in, actually it's been seen as a relatively kind of safe autumn statement. So at least we have that to be grateful for. So in terms of lender pricing changes, there haven't really been a lot of changes, and understandably so, because we had a bit of yo-yoing in the run up to the autumn statement. I think a lot of lenders were kind of like, okay, let's just get through this and see what happens before we start going to the huge amount of work of, you know, amending our product range. So actually in the last week, we've only really seen a handful of lenders make very, very minor changes. The one that I thought was really worth mentioning, because it's in buy-to-let rather than in the resi space, is Virgin Money, who have brought down a few of their lower loan to value products by 0.1%. So I think really the point of even telling you this is just to let you know there hasn't really been any changes in terms of fixed rates. No one's really been repricing. Do I think we're going to see some changes coming up now in the next week? Yes, because we're going to see a bit more stability. So people who have maybe been looking to make changes but been just waiting to let the autumn statement come into play and see how the dust settles will be more comfortable to do so. But don't forget, guys, we're also, how can you forget at the moment, in the run up to Christmas. Therefore, actually, you know, we do sort of see things start to wind down. Interestingly, the first couple of months of December tend to be two of the busiest months of my year, but then people actually kind of switch off for the rest of the year. So I think in terms of rates, my kind of prediction is we may see a couple of lenders make some tweaks to their pricing, not because their cost of funds have come down, simply because they're looking to, you know, try and drive up some last minute business volumes. But broadly speaking, I don't think we're going to see any real changes on fixed rates between now and the end of the year. Now, for those of you who are waiting for the MPC Bank of England announcement later on this month, before you make any decisions, just to be very, very clear, the markets have pretty much emphatically priced in a 0.25% reduction into fixed rates now, into your swap rates. So actually the reality is that if you're waiting for the MPC meeting to happen before you crack on and get your mortgage applications in, the chances of you seeing any material difference in interest rates when base rate comes down, assuming it does, are very, very slim. I think actually the bigger risk to you is if you wait and the base rate doesn't come down. That's going to really throw things up, because actually a downward pricing movement has been put into the markets. If actually base rate doesn't come down, that means that swap rates might actually tick up a little bit. So actually maybe waiting isn't the most sensible thing to do just now. Okay, now in terms of lender criteria changes, we've seen two lenders, both specialists, make some fairly good changes actually to the lending policy. So the first one is our friends at MT Finance, who have removed their minimum income requirement for buy-to-let applications. So previously they were saying actually to have a mortgage with us, you need to earn an arbitrary figure. Actually going forwards, you don't have to have that figure in place. So as long as you earn something and the case kind of makes sense. Now, what do I mean by this? So it might be that we have an applicant who has an income of £22,000 a year. They have a residential mortgage of £100,000, 10 grand on credit cards, car on finance costing them £300 a month. That person's going to feel pretty stretched every single month. It might be that we have someone who earns £15,000 a year, has paid off their home mortgage and has no unsecured debt. So actually the lower income earner in that situation is the person with the most disposable income each month, and therefore they would make the better kind of sense to lend to. So when I say no minimum income requirement, as long as it makes sense, that's the kind of thing that we're talking about. Now, what I would say here is just to be very clear that actually first-time buyer, first-time landlords do still have a minimum income requirement with MT Finance, okay? But actually, for the majority of you watching this video, that's not going to apply. They have removed their minimum income requirement for the majority of buy-to-let applications. Now, the other thing they've done is they've made the move to now accept first-time landlords and first-time buyers who are applying to buy smaller HMOs. So small HMOs tend to be HMOs of up to 6 bedrooms. Now, are they unique in doing this? Absolutely not. There's other lenders who will accept first-time landlords who are buying an HMO for the first time. Again, it has to be small, so there's really very little chance that if you're a first-time landlord, someone's going to finance you buying a 20-bedroom HMO, because you simply don't have the experience behind you. You need to cut your teeth on something smaller first of all, and then kind of come up to the bigger properties. But the interesting thing here is the wording first-time buyers. So actually you can have no property at all and still come to MT Finance and they would lend to you on an HMO. So that's really, really good. So well done, those guys. The other change we've seen in the last few days is that fleet mortgages have changed their minimum age requirement. So what they used to do previously is say that their minimum age requirement for first-time landlords was at 25 years of age. It's now 21 years of age, which means that actually for all applications, all applicants, there is a minimum age of just 21 years. Now, this is an interesting one because people often, when they're thinking about mortgages, think about maximum ages. So actually, you know, can I take the mortgage up to my 80th birthday? I'm 78 years old. Can I ever get a buy-to-let mortgage again? The answer is yes to both of those, by the way. But actually, people rarely think about the younger end of the spectrum. So actually, the first thing to say is that you cannot legally contract until you're 18 years of age. So you simply could not get a buy-to-let mortgage if you were under the age of 18. But most lenders these days in the buy-to-let space, and particularly the specialist end of the market, so your limited companies, HMOs, multi-units, all that kind of stuff, tend to say we're quite happy to lend to you as a young person, but you do need to be at least 21 years. Now, there's always exceptions to this. There are lenders who can take on people in the specialist end of the market at 18, but just to be aware that actually most lenders are saying we want you to be at least 21 years of age. Okay, now moving on to pets in properties, which I know is a very, very contentious one. There's been some further guidance issued with regards to reasonable refusals, and I thought actually because so many of you are generally not very happy about this particular change in the Renters' Rights Act, I'll just share it with you in a bit more detail. So the government has set out the reasons landlords can cite to refuse pets in their properties, although just to be very clear, the balance of power does remain with the landlords. Sorry, the tenants, God, that would be unusual, wouldn't it, for it to be with the landlords these days. So under the Renters' Rights Act, measures coming into effect in May, if your tenant requests to keep a pet, you will not be able to refuse without a fair reason. So the kind of purpose of this is what is a fair reason. So before we just go into that, just a couple of other points. So you're going to need to consider each request on a case-by-case basis. So you can't have simply a blanket no. And once your tenant has asked for a pet, you have to respond in writing inside of 28 days. If you don't respond within 28 days, they can then apply to a court. Now, in the guidance notes for the new legislation, the government says it may be reasonable for a landlord to refuse to request a request in some circumstances, and these are if another tenant in that property has an allergy, the property is too small for a large pet or several pets. So, for example, the example that people always come up with, which is kind of extreme but actually fair, it's a studio flat and your tenant wants to keep a horse in it. That would be totally unreasonable. But likewise, it could be that you have a one-bedroom apartment and they want to keep 3 Great Danes. That would also be unreasonable. So it's kind of a common sense approach here, but the key point is the property is too small for a large pet or several pets. Another one would be that the pet is actually illegal to own. So I can't actually think off the top of my head a pet that would be illegal to own, but actually that would be not allowed or a reasonable reason to refuse the property. And the last one is that actually if you're a leaseholder, so you own a leasehold property and the freeholder simply doesn't allow pets in the property. So I guess with that one, it's quite a straightforward conversation. You want to have a pet in the property, it breaches the terms of the leasehold, you can't do it. Now, some guidance notes about reasons that are not reasonable, because I think this is also as important. So the first reason that you can't refuse pets in properties is that you do not like pets. So no matter how much you might dislike animals, that in itself is not a reason to refuse your tenants having pets, I'm afraid. If you've had issues with tenants who have pets in the past, and that's one of the main reasons why people don't want tenants to have pets in properties, is that actually previously someone had little Max, the Jack Russell, and it chewed up the carpet. Therefore, we don't want to have pets in the properties going forwards. That isn't going to wash, I'm afraid. If you've had previous tenants with pets who damaged the property, same kind of thing there. If you have general concerns about potential damage in the future, so simply, I don't want you to have a pet because I'm worried that it might, wreck my house, that's not going to work. Also, if you think a pet might affect future rentals, I don't entirely understand that comment. I suppose it might be that actually you have a tenant who has a dog that barks all night long, therefore the neighbours are really kind of unhappy about that fact. Tenant moves out, they then were to moan about the previous dog to new incoming tenants, and that would put people off. So that couldn't be a reason, if that was a concern of yours, to say no. And then finally, if you know the tenant needs an assistance animal such as a guide dog, so actually you can't refuse that. If your tenant actually has a genuine need for an assistance animal, that would be another reason why you couldn't simply refuse. So there you go. There's some kind of food for thought, and hopefully within that there is a kind of level of reasonableness as to why you could say no to having a pet in the property. Again, I think most of us are kind of more accepting of the fact that it is what it is. This is coming in. People are going to be able to ask for pets. We can't simply say no just because we don't fancy it. Therefore, people are now being very, very good at looking at alternate measures in terms of insurance policies and that kind of thing. And as we have more information on this, as always, we will keep you posted. Okay, now as we get into the end of the year, it's very, very normal for us at MFB to start looking at lots and lots of data. I mean, obviously I'm looking at data all the time, but really look at data so we can come back to you guys and tell you, over the year what's been going on. And we will be doing that with a really insightful newsletter that's going to be going out. But one of the things that's always really difficult is that actually when you start Googling, for example, house prices, UK 2025 average UK house price, you'll get a set of data, and then you'll look at a different set of data from a different provider, and one's showing you that house prices have gone up, and others showing you that they maybe have flatlined or gone down, and it's very, very confusing for people. So what I want to do just now is just briefly go into the different kinds of data sets and where they come from, so that you can kind of at least get a kind of view on why you're getting many different types of data that's been shown. So the Nationwide and the Halifax, their house price data is based on mortgage approvals. So these figures move early and reflect sentiment and buyer activity, but exclude cash buyers and mirror each lender's customer base. So essentially what they're saying is that actually they're using data from their own mortgage applications. What they're not doing is looking at data from across the whole country. So it could be that actually Nationwide launch a really, really hot first-time buyer product where you don't need to deposit, as an example. Therefore, they're going to attract a disproportionate number of first-time buyers through their mortgage applications, and therefore the house prices they're going to see are going to be very, very reflective of that kind of applicant. Whereas conversely, the Halifax might launch a really, really nice large loan proposition, get loads of applications for really big houses which aren't going to be your first-time buyers, and therefore that's going to paint a very different figure. So I think the key things are, first of all, mortgage approvals, so not completions or actual sold prices, and secondly, it's only from their own data set. Now we have the ONS and land registry information. This is based on completed sales. So not I put the property on the market for X, or I've made an application for a mortgage at this figure. It's actually on how much things have sold for. Arguably, in my opinion at least, this is going to be a very, very accurate representation of actually what's going on. Now, a couple of things here. First of all, this is including cash purchases. And also it's not going to be representative of any one part of the market, because it's taking all of the transactions that have gone on in the UK and only those which have actually gone through to completion. So I think really for me, ONS data is probably the one which is the most accurate in terms of painting a real picture. Now, other ones that you may see, Rightmove is a big one, tracks asking prices of new listings, which is a good measure of seller confidence rather than actual values achieved. So, for example, if we see suddenly lots of sellers are putting properties on the market for a higher level, that really reflects good selling confidence. Likewise, if we're seeing asking prices start to dip, that could imply that actually the market is much more subdued. Estate agents are really kind of advising potential sellers to dumb things down a bit. And Zoopla actually is a very interesting one, because it's combining listings, mortgage data and modelling, sitting between sentiment and completed reality. So this one's kind of like all-encompassing. Each to their own. I think for me, like I say, I prefer the ONS data. That just feels like the most kind of factual, broad set of data around. You may feel slightly differently, but hopefully at least that goes to at least somewhat explain why you're going to see lots of different types of data coming, being published at the end of the year, and where it all comes from. Now, one last thing for you before I shoot off for another week, and that is that we've released the latest in our Meet the Lender series, this time speaking to the Leeds Building Society, a lovely lady there called Siobhan. And one of the things that I found particularly interesting within that conversation was the kind of view of the Leeds Building Society in terms of the future of limited company buy-to-let mortgages. So here is an excerpt for you to watch, and there's a link below for you to click on if you'd like to watch the whole thing. It's really interesting.
Our limited company buy-to-let market is new for us, and as that market matures, remortgages will take a larger share of that for us as well. So it just gives customers the choice of going down the buy-to-let standard historic route for buy-to-lets, or going into the limited company space with the tax advantages of that. And 60 to 70% of the buy-to-let purchase market is now limited company, so we expect it to remain the same for going forward. So that's going to be a big change, and all lenders are sort of following suit from that. The dominance of limited company in the purchase market will gradually feed through to a larger market for limited company remortgages, which is what I've said as well. So we're sort of really seeing that now.
And that's us for this week. Thank you as always for having a watch or listen. Really appreciate it. And as always, you know that if you have any questions, we'd love to hear from you. 0345 345 6788. Or by all means take a nosy around on our website, where you can also do an online chat or fill in an inquiry form, and we'll reach out to you. Do have a fantastic week. Do keep warm. Good luck with the Christmas shopping, and for those of you getting your decks up, and I will see you again next Wednesday.